Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Mester and Tim Stenivek from Bloomberg Radio.
Well, big week for markets thanks to two cooler inflation prints, a Fed meeting, catching the Acela or shuttle. I'm not sure how he got there, but he was in D.C. for the Fed meeting this week. Bloomberg News international economics and policy correspondent Michael McKee, he was at the Fed on the day of the decision, and I have to say, asking a really smart question to Fed Chair Jay Powell, which we'll get to in just a moment.
Are you just saying that because Mike's in here?
No,
okay.
He knows.
Sucking up.
He
okay.
I do suck up, but he also knows I'm really honest. Mike joining us in studio, not wearing shorts, but wearing some great salmon, or should I say, AKA pink pants?
No, these are Nantucket Reds.
Oh, Nantucket
You
Reds.
have to have the right
Blasphemy.
Yeah. Not to be
These
confused,
are from Nantucket. Actually.
Not to be confused with like a Martha's Vineyard red.
Yeah.
But yeah, Nantucket Red. It's a red.
All right, it's Nantucket Red Pants. What continues to follow you? Focus team. What continues to follow you after the Fed meeting?
The fact that they don't really know what they're going to do, I think, is the bottom line. You hear everybody, and Loretta Mester was just on with us, and you hear from everybody else, same thing, Jay Powell, that we're looking for more data to confirm what we think is going to happen. And when we get that, then we'll consider cutting rates. But we don't know when we're going to get that. It might come next month, might come in 2 months.
You're saying data dependent.
Data dependent, although this is something I brought up with Loretta, and she thinks one of the things that Wall Street gets wrong is the critics say, well, the Fed is data dependent and all the data is backward looking. So they're going to be behind the curve. But they forget that they're constantly talking to CEOs and business leaders and people in their districts who are telling them what they're seeing in real time and telling them what their plans are going to be going forward. So they have the mix of the past data which confirms or rebuts what they've been told by people, but they have a pretty good idea of what things are happening in real time as well.
Okay, so let's talk about some of that data, because I think it's fair to say, and forgive me, but CPI on Wednesday morning, at least from an equity and bond market reaction, seemed to overshadow what we got a little bit later in the day from the Fed chair. That said, we also got PPI that came in cooler than expected, another Fed-friendly report. Those two bits of data, along with some of the jobs data, not the payrolls report last week, but other jobs data like JOLTS that we got, all seem to fall into sort of one bucket of being Fed-friendly, what the Fed wants to see. But then you have the May payrolls report. That is the outlier here, Mike.
Well,
what's going on?
You have the payrolls report showing lots of jobs created in the establishment survey and 400,000 jobs lost in the household survey. And I did ask President Mester about that, and her view is that you just look at both and you fold it into your overall impression of all of this data that they are looking at. And historically, the establishment data has been more accurate, but you have to take into account the possibility that there's something going on that the household survey is picking up. So they're weighing all of this. In the end, they have a binary decision, raise or cut. And they have to take all of the information that they have and bring it into making that one decision.
I still kind of obsess, the Fed obsesses about this 2% target. You did ask Loretta Mester about that, and this was just about an hour ago. Mike talking with the Cleveland Fed president. Let's listen to what she had to say about the Fed getting back to that target.
It's going to take some time to get inflation back to 2%, all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down.
All right, that, of course, Cleveland Fed President Loretta Mester with Mike earlier. Mike, that darn 2% target. What did Jay Powell, I thought there was a headline. I was trying to go through my headlines from Jay Powell on Wednesday. I thought there was something where he kind of questioned maybe getting there. Or that.
Well, he said basically the same thing she said, that it's going to take longer than we thought, and the Fed's kind of modal forecast is that it would take till 2026, the same as she said.
That's 2 years from now.
That's
or
2 years from now.
Year.
But
how do we know?
But there's a subtle shift underway here now that you're hearing from Powell. We heard from Mester, and I bet you'll hear from other people too. They're kind of moving away from we have to hit 2%, just using that term 2%. They're not going to move away from the target, but what they're looking for is to get inflation back to Alan Greenspan's old definition of inflation, that it doesn't enter your mind when you're making purchasing decisions. You go to the grocery store and you're not thinking about how high prices are.
So the idea versus the number?
And the idea versus the number, because it's the idea that drives decisions. Now, for businesses, they obviously are plugging into a spreadsheet what inflation's going to be and what their discount is going to be. So it's important to them. The lower you get, the better off, the happier they are. But for the average person out there in consumer spending, if you walk into the grocery store and your first thought is not, wow, that's expensive, then they've gotten back to where they need to be, even if it's 2.2 or 2.3%.
I did think that was a really interesting moment of the press conference toward the end when the Fed chair was asked about sentiment. And sentiment sort of like the old-fashioned way, like, people, what message do you have for people who look at the data and say, yes, things are good out there, but we don't feel good?
We got to read on that today, right?
Yeah, I commend to you and to our audience, if you have a Bloomberg, or if you don't have a Bloomberg, call us and Carol will get you one.
Wow, I didn't know I could do that.
If you can't do that, subscribe to Bloomberg.com. David Wilcox, who was a longtime senior Fed official, has an interesting column out today where he looks at the difference between the Volcker years inflation, where inflation got into big double digits, and consumer confidence didn't fall all that much. And the difference between that and now, when inflation didn't go up as much, but people are extraordinarily depressed. And one of his arguments is that it's the media, that there is a media ecosystem now that you can never get away from the news. And people who don't live in New York and look at their Bloombergs all day long didn't get the exposure to the news about this sort of stuff that they get now. Plus, layer on that social media, which is not just an echo chamber, but it's filled with false information, and then all kinds of people arguing and fighting with each other over this stuff.
Politically, it's a great tool
and
to play around with, too.
That makes people much more unhappy because they're living this thing all the time. And I thought that was a pretty good explanation. I do an interview with Joanne Chu from the University of Michigan every month, and she was saying basically that makes sense to her because basically there's a lot of things out there right now that are depressing, and she said there is no their survey's been around since 1946, no comparison between then and now in terms of, they have a category called have you heard bad news about the economy? And she said the number is just way, way up now. It doesn't compare.
Wow.
I mean, bottom line, inflation, it's not going up as much, but it hasn't, we're still paying higher.
It's the level that bothers people because they remember that it was lower before the pandemic, and so now they're saying, well, it hasn't come down.
But it's never going to go back to the price of something pre-pandemic. That's not how inflation works. And I'm wondering if there is a generational issue here, Mike, that there's very many people who this is their first time ever dealing with inflation, so they don't know how inflation works.
Yeah, there are a number of studies that suggest somewhere around 2 years. It takes 2 years to process a level of inflation, as long as it's not still rising dramatically, and then it sort of falls away in your mind. And I don't know exactly what the 2-year timing would be, but that could be as well. And as you say, a generational issue. The older people are going to get over it sooner, perhaps, but the younger people are going to hang on to it for right now. And we have a problem with housing, too, that we haven't had before. There's a housing shortage for a whole lot of reasons, but that's keeping home prices up. And for a lot of young people, that's a big deal.
And that plays into it in a big way. One thing I do want to ask you before you leave, Mike, because I do feel like the question you asked, and I don't know if I've got it perfectly correct, but it was something to the effect about if, the Fed expecting rate cuts, later this year, next year, when essentially the U.S. economic backdrop will be the same. I think it was something to that effect. Like, how do you square that?
Well, the end of this year, their new economic forecast is that growth will not slow. It will be the same as it is right now, and that unemployment will not rise. It will be the same as it is right now. Headline inflation will not change, core inflation will actually go up, but you guys are wanting to cut rates. Why? The answer is what I expected him to say, basically, that what happens is if inflation keeps going down, then real rates go up. And so that imparts more drag on the economy, and they don't want that. They think they're restrictive enough right now, so they would need to calibrate the rate to where inflation is.
All right, have a great weekend. So appreciate it. Michael McKee, international economics and policy correspondent at Bloomberg News, here in studio. You did ask Loretta, too, about the Indians.
Yes.
The Cleveland Indians.
Cleveland Guardians.
Guardians. Sorry.
Yeah.
Sorry.
Yes. And she
a
said
big baseball fan.
I'm
she
so
said
sorry.
She said it was monetary policy that has them in first place.
I love it.
Love her, man. Not missing a beat.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
A story we have been dying to get to. We touched briefly on it on air. Workers at one particular company quitting in droves, with half of all new hires leaving before their first anniversary. Bummer and costly.
Costly is the important part to focus on here. With more, let's bring in Bloomberg News senior management and workplace reporter Matt Boyle. He's here in our studio. The story centers around a company that I think everybody knows, and perhaps in their 20s, 30s, maybe 40s,
because
and 50s
of the bully
too,
bookshelf?
knows well.
Exactly.
Ikea is what we're talking about. It's a unique company for a lot of different ways.
Yes.
But what did you find when it came to turnover?
I mean, what I found when I came to turnover was some things that are endemic to retail. You know, they were having an issue, but also through this kind of Swedish lens where they're actually like, well, let's try to do something about this. We're in so many different markets, and there were different pain points in each market, which was really made the story interesting. In some parts of the world, it was simply just pay. You know, we want to be paid more, we want to be paid equally, gender pay gaps were in existence. In other parts of the world, it was onboarding. New employees felt lost. No one was talking to them. They were just sort of like, what do I do here? In other parts of the world, it was benefits, you know, paternal leave, for example, in India was one thing. And then the US, shockingly or not shockingly, it was about shift scheduling, which is just a real bugaboo.
We often talk about it being expensive for a company when an employee quits. How expensive was it for Ikea?
For Ikea, they were telling me it was $5,000 a pop to replace someone who left. And to be honest, that might be low, because I've seen plenty of other estimates from HR experts who say it can cost nearly 1x or 1.5x the salary of someone to replace them when they leave.
Because of the training and like what?
Yeah,
you
got to pay someone to hire a new person.
Yeah.
You got to pay someone probably to also, you know, manage the exit of the first person, hire the new person, train the new person, and then you lose productivity because that new person is not as productive or as efficient as the person who left.
And during the pandemic, you had to find that person,
was the other
which is still an
big
issue, right?
Huge problem during the pandemic. I mean, look, the Great Resignation hit everybody, but it hit few industries harder than retail. Retail work has always been tough, low paid, long hours, annoying customers.
Oh, yeah.
But then during the pandemic, all of a sudden, every retailer was now an e-commerce fulfillment center.
Right.
And you had people picking up orders on the curbside. Remember that?
It's frenetic.
And then you've got people coming in who don't want to wear a mask and are like, you know, spitting on workers and all this horrible behavior. So some retailers were handing out hero bonuses, but that was just the depths of COVID. Those ended. And so retail, they see voluntary turnover rates, quit rates, 70% higher than most other industries.
I'm a little surprised because Ikea is it gives off a warm and fuzzy feel. You know, the home of the rubber ball pits for kids to play in, those great bags for shopping, Swedish meatballs, dare I say
Couples
more.
fighting everywhere.
Yeah, they've got this sort of Nordic vibe going, and which is great. But again, remember, these are hourly retail jobs, and they were getting in trouble all over the world, to the point where it wasn't just one union in one country that was complaining. They had an umbrella union put forth a complaint to the OECD saying we are being treated horribly, there are different standards in different markets, and it went all the way up to the top. It took years to settle. They finally came to an agreement, but while this is going on, workers were just leaving in droves.
There's one stat in the story, I just got to go to it. By 2022, more than 62,000 employees were departing a year for various reasons, equating to about a third of its workforce, and the pandemic-era labor shortage made it difficult to replenish its ranks. That number, though, is staggering.
Yeah.
That's a lot.
It's very rare, and kudos to them for at least disclosing it. Because you ask Walmart or Dollar General how many people quit last year, you're kidding. You're never going to learn that at all. So IKEA, is in their sustainability report. Now, granted, that number does include workers who were involuntarily departed, so who were fired, but still, the bulk of them were voluntary quits. And that was a peak, and that's when they realized, we have to do something about it. At the same time, it's hard to find new people.
Okay, so you talk about doing something, and it depends on the country that
Exactly.
IKEA was in and operating in, and what specifically those employees were looking for. But how would you characterize the big change that they've made at the company in order to retain workers better?
I mean, the big chain, look, when it comes down to people say, I want to work for a company that supports my values and that has a purpose, but it's pay. Pay and benefits is what holds on to people. And also whether or not they feel there's a career path at the company. That's another big thing. You might enjoy your job, but you're like, I don't really know where this job is going.
Right.
That's a huge problem, especially in hourly retail. It's like, maybe you don't need to work stocking shelves the whole time. Maybe you could work in customer service. But companies are very bad at telling their employees, we see this path for you.
Right.
Because that takes time and investment and money, and who's got time for that when someone's making $14 an hour, right?
How much did work-life balance come up? I feel like, there was so much after the pandemic where people were talking about it. Employers were saying, we hear you, we understand. It feels like it's sliding back a little bit.
Yeah, they were saying we hear you, but then it was often like, hey, let's have a pizza party, or hey, here's a free app for wellness, call it a day. It was
Go meditate in the corner.
Yeah, exactly. Go meditate. Here's a yoga mat, have fun. That's not going to do it long term. Especially if you're dealing with burnout, anxiety, stress, serious mental health issues in this workplace that companies have just sort of taken these token approaches to. So at IKEA, for example, yes, all workers were asking for more. I remember in India specifically, for example, a lot of companies in India demand that their workers have a 6-day work week. IKEA said no, 5. So also paternity leave, a big rare thing over there. Mothers were often getting leave, but not all dads. And even if dads were getting paternity leave, they weren't often taking it. So the real encouragement, you have to tell people, you can do this. Give them permission. That's a big part of all this.
You're not going to be penalized for
Exactly,
taking it is a
exactly.
big one.
To what extent is IKEA an outlier globally when it comes to the sector?
They're an outlier just for giving me this data. My goodness.
Yeah.
It'd be great if more companies would actually, they talk a good game.
Well, and it's a privately held
Yes,
company
that's
too.
the reason why. They don't have Wall Street to answer to. It's a very weird structure. You have this parent entity that controls, their licensing and franchising and product design, and then you've got this company called Inca, which is actually the company I talked to. They run the stores. They hire the people. They're like the franchisee, in other words. So, but they're massive. They employ nearly, 165,000 people.
It's a lot of people. Hey, I wonder if they gave you any data on wearing shorts at the office. This is another Bloomberg opinion columnist that's out
Hard
there.
pivot.
Yeah.
You have your own story about wearing shorts.
I wouldn't wear shorts if I worked retail. That's a lot of hard work, and you get a lot of skin knees there. But yeah, wearing shorts at the office is yet something. All these norms in the workplace have fallen by the wayside. Is wearing shorts, especially as a guy, is that also going to fall? Look, I wear sneakers every day to the office. I never would have thought of doing that pre-COVID. So is shorts the next, big thing to fall? I'm not sure.
Have you ever done it?
I did it once in the late 90s, my first job in New York. Everyone stared at me and my hairy legs and said, Boyle, no. That was the last day I wore shorts in the office. So, today's casual Friday, though I'm wearing jeans. That's as far as I'll usually go. But, jeans can get pretty hot in a New York summer. So, but I'm a bit more old school about this. I'm Gen X. I don't see myself wearing shorts. Now, on work from home days, anything goes. And that's what's influencing, obviously, in Sarah Green Carmichael's column, her great column today. That's one of the things that is driving this. It's like, well, I was wearing shorts 5 days a week during COVID. Hey, who's gonna ask twice?
Also, just so you know, heat wave in New York starting next week. So
Says the guy who throws on shorts to go home.
I wear them. I wear shorts into the office because I ride a bike, Then I change into,
Everything
a
is
suit.
There's a lot of,
does,
change.
he does.
Presto
And then
changeo does happen.
The problem
always
is,
wanna,
is
like-
the problem is the people who see me wearing shorts on the way to changing. That is
Yeah.
the
I
I want
worst
to get
part
out
of
a
the
soccer
day.
ball, a ball, and start like
And
kicking
then having
it around
Carol
with
make
you.
fun of me whenever she sees me, which is every single day.
It's really kind of charming. You are always charming as well. Thank
very
you for
much.
always
Thanks, guys,
pitching
for having
stories and reminding us of some great stuff that you guys are doing. Matt Boyle, he's senior management workplace reporter at Bloomberg News, not wearing shorts. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So that brings us to
Cava, because of all the hot IPOs over the past year, AI firms and biotech startups and the like, none has popped on Wall Street quite like Cava Group. The restaurant chain, it's the Mediterranean Chipotle, its financial backers like to call it, soared more than 300% since the IPO back in June of 2023. That was a year ago. Now it's got a market cap of over $10 billion. Bailey Lipschultz is Bloomberg News Equities reporter. He joins us here in the Bloomberg Interactive Brokers studio. All right, I'm going to do some math here, Bailey.
Yeah.
$10 billion market cap, 323 restaurants, beep, 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 beep. About $33 million per restaurant.
Could you do that again?
I'm no financial analyst, okay? I'm no financial analyst.
Please.
But I just copied that
Maybe
right
at
from
the
Bailey's
end.
article. He did the math. Is that valuation a bit rich to its peers?
According to some of the analysts, we had JP Morgan downgrade the stock a week and a half ago, saying that it is unprecedented to have a per restaurant valuation like that.
$33 million per restaurant.
Just for comparison, the gold standard in fast casual,
Okay.
Chipotle, the actual Chipotle Mexican grill, about $25 million. So this is
Today.
about
Okay.
per store. So about a factor of what, a third, 30% higher for a company that only has 300 and change.
What's the revenue per? Do we know revenue per store?
About $2.5 million
For-
on average
for Chipotle or for Cava?
For Cava.
$2.5 million. Okay, what about Chipotle?
Chipotle is actually kind of closer to that. They're closer to the $3 million mark. I thought it was going to be a lot
Interesting.
higher.
Yeah,
but,
so did I.
But when you look at the story, so you look at Chipotle and you go back to when it went public, had a number of issues back in 2006. Then 2015, 2016, they really hit the gas pedal on expansion, had those issues with food safety, had a number of problems and headlines. Took them more than 2 years to recoup
I was
those
going to say, it was a
losses.
few years. It wasn't just like one little thing. Yeah.
And so that's the thing when I talk to people who are skeptical of Cava is they're talking about 1,000 stores within the next decade. How that growth works, how you can find and train employees, and how that expansion actually operates. While, again, when you look at where they're popular, Northeast California, it's people who can spend $14 on a bowl of falafel or lamb gyros.
Bailey, as part of the reporting on this, did you go to Cava?
I did not. I'm still mad. I still don't know how I didn't get to expense Cava.
Does it also speak to just people,
$14?
People want to partake in an IPO, and we just haven't had a lot of IPOs. Like, what is the thinking about why investors are pushing it up so much?
I think people like a growth story. So the idea that you have a restaurant company who is going to essentially 3x their footprint in the next 10 years, has pretty strong margins, has ability to capture kind of that brand mentality of the Mediterranean
And people
Chipotle.
are really into that diet, that food, if you will.
And people also are bidding up stocks that are within the fast casual space. So you see Wingstop up quite a bit. McDonald's even has been knocking the ball off the cover in terms of stock performance. So when you look at where investors are putting cash to work, it does seem like they're buying brands they know. They're buying companies that you could make the argument if people are downshifting some of their spending instead of going out to eat, maybe you go to a Cava or a Chipotle. On the flip side, if you're a New York banker and $14 for a Mediterranean salad is really nothing bad.
I was just going to say, love me some McDonald's French fries or even a Happy Meal. Don't judge me. But the fast casual folks are calling and they're like, wait, I don't know that McDonald's is fast casual.
Yeah.
This is true. Oh, no, definitely not. I mean, you think about a Sweet Green is like a peer. Chipotle, you
Right.
mentioned Shake Shack. Wingstop maybe is kind of a peer. You have it in the story as a valuation multiple peer.
Yeah, a better comp, just because, I mean, McDonald's chart actually
I'm
is
not
pretty
judging
ugly.
you.
I hadn't looked
They're
that
calling
closely.
and saying, or
But if you look at Wingstop stock, it's doubled in the last year.
Yeah.
It's up 200 and change in the last few years. So it's still kind of with that market penetration story, the idea that maybe people are going to be more willing to spend up for some food.
I am curious too, and I just want to pull it up here. Short position is 15%. afloat. So people, because it's been such a tremendous run, it's
been pretty flat
consistent?
though. That's kind of been
so it hasn't changed.
It hasn't changed much in the last few months. That was one of the things we first looked at was, all right, well, $10 billion feels lofty for a company that still needs to grow quite a bit into that valuation, but it doesn't seem like shorts are betting against it. Even when I talk to someone who's taken a short position, the argument is it's still expensive and it still hasn't quite worked out. And if you're arguing for fundamentals to matter, as we've seen really over the last 3 years, the market can hold out longer than you can keep a short bet on.
All right, interesting.
Bailey, let's talk about share sales. I know it's something that we follow closely here at Bloomberg. And Carol, I do want to mention, you reminded me of this. Ron Shaich, who we've had on the program, founder of Panera, he is the 5th largest shareholder of Cava. And his stake, he's also the chairman of the board. He's got, about $500 million worth of Cava stock right now.
Yeah.
But there's been some share selling.
Yeah, we've seen some sales. Now I obviously can't pull up that BFW we were just talking about earlier. But we have seen a number of the larger shareholders lowering their positions. We saw, at least within some filings, going ahead and showing that insiders have sold $369 million worth of stock. So Artal is their largest shareholder. According to these filings, they sold about $262 million worth of stocks, 3 million shares underlying that. But Shaich, to your point, selling 1.23 million shares, $107 million of profit, which, again, if you're a fundamental analyst, though, it's not a bad payday when you're up 4x from IPO, and who knows how low you got in pre-IPO.
Well, probably some financial planning.
Yeah, well, listen, and a lot of these guys, he is someone who's played in the space. They tend to provide startup money, or they get in when a company's kind of developing who they are, their model. So early money, right, investor money, and then at some point you're like, okay, I'm done. That was my seed money, my venture money.
I'm gonna go buy some Cava now.
A Cava,
a $14 bowl.
Cava. Sorry.
Have you tried it ever?
I had it. Me and my fiance split a falafel bowl last weekend.
Okay.
All right.
It's a little prep.
I mean, well,
so Carol asked me how it was, and I was like, yeah, I've been.
I'm also just like such a fan of halal street cart food here in New York. So it's like for $7, I can get really good, terrible for me food, or I can spend twice the price for something that's arguably a little bit worse, personally.
Yeah. All right. Well, anyway, it's certainly been on a tear, and something we're watching. I know, for many, many reasons.
Doesn't get any better than this.
Have a great weekend. Thank you. Bloomberg News equities reporter Bailey Lipschultz.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Lots of headlines about Spotify and its membership plans over the last week or so. Before that, Carol, last week Spotify said it would raise prices in the U.S. by $1 per month in July, so it brings its standard paid tier up to $11.99 a month. It increased the sub price last year to $10.99 a month. That was from $9.99 after not having touched its price for more than 10 years. So a couple price increases after a long time of not increasing the price. Now the company is introducing this new higher price premium plan. It's going to cost $5 more per month. Shareholders certainly cheered that news after our next guest reported it earlier this week. Ashley Carman is Bloomberg News music and audio reporter. She writes the Soundbite newsletter, which you can sign up for at Bloomberg.com. Ashley joins us from New York City today. Ashley, I want to talk about how much opportunity Spotify has to raise prices, because you can get what Spotify offers to a certain extent from other services. How sticky is it, according to your reporting?
So the music industry is certainly bullish on Spotify and believes that music is wildly underpriced at this point, regardless of the fact that the same music is basically available across many streaming services. My colleague Lucas Shaw has previously reported that Spotify, compared to video streaming services, is particularly sticky. And so I think they probably do have some room here to play around with price, and likely will not see a ton of churn because of it.
It's really interesting for those folks who used to buy actually records and tapes and cassettes and all that stuff. Like I think about how much I use, access my music on my phone and so on and so forth, that you do wonder, is it kind of underpriced considering the money that we used to shell out for, buying individual, like I said, albums, if you will. Like you do wonder, is there kind of the analyst investments, argument that truly is the case, and this is why this makes sense?
This is what the music industry is saying, is they really believe that, yes, like to your point, and even now, a record of vinyl, which is growing in popularity again, actually. I mean, those could be $30, $40, and we're paying, $11, $12, whatever it might be, for access to the world's history of music, essentially. So the music industry really does believe that, yes, this is critically underpriced.
Okay, but actually, I got to tell you what is, I think, more valuable to me than the music that Spotify offers me every month, which I can get on Apple Music if I wanted to, is the data that it has about me and what it knows about what I like, what it knows about what I listen to, what it knows about the podcast that I listen to. In fact, I never see myself quitting Spotify as a result of that, because that to me is valuable. Am I weird, or is that kind of like what Spotify goes for with stickiness?
No, I think that's exactly the thing. I mean, some of us have been using Spotify for maybe 10 years now.
Yeah,
or
definitely
more,
me.
potentially.
Yeah.
Yeah. And so at that point, they have so much of our historical listening data. They have their Discover Weekly playlist. They know so much about us that to start over somewhere else and also have to create our playlist somewhere else, that's actually a pretty high bar for a lot of folks.
All right, so talk about these increases in terms of prices for Spotify, because I was kind of blown away. I haven't looked at the stock in a little while, and it's up about 67% this year. I mean, the chart is so clean if you kind of, for the most part, go back to December, but really, in reality, if you go back to kind of late March, what it means for the company in terms of its balance sheet and how it moves the needle.
Yeah, so obviously this can translate to lots of new revenue with the price increases specifically. But I think what you're also seeing in the stock this year is the fact that Spotify has really just tightened its spending overall. Looking back even a couple of years ago, I mean, they were spending in podcasts like crazy. Investors did not like that. They wanted to see a much higher return on that investment. And really, what ultimately happened was Spotify just pared down its ambitions in podcasting quite a bit, and now really doesn't have as much of an original content arm. You're seeing that. And also this reaction to Spotify introducing audiobooks to the platform, which I think investors are probably a little bit, I don't know if they're fully into it yet. I think they're probably a bit just waiting and watching to see kind of how user uptick happens on there, and if people really convert, let's say, from Audible or just end up using the service for audiobooks as well.
I mean, I'm pretty delighted by it as a Spotify customer, because books that I used to have to buy on a service such as Audible are available for free on the platform, Ashley. And I'm wondering how the agreement works with Spotify, how they're able to do that, because that just costs them more money without it costing me more money.
Totally. Yeah. So I think that this is a bit in the weeds, but actually there is kind of a separate story going on related to this right now in Spotify. And that is when Spotify introduced audiobooks to its service, it kept prices the same, to your point. Obviously, they're now increasing it, but broadly speaking, they kept it the same. And the music industry in March found out that because Spotify introduced these audiobooks and was introducing new plans, like an audiobook only plan and plans to introduce a music only plan in the US, Spotify is now classifying itself as a quote unquote bundle to the music industry. And what that essentially means is they pay a reduced royalty rate to songwriters. And Billboard estimates that because of this new classification that Spotify is claiming, over just the first year it's in place, Spotify will pay $150 million less in royalties to songwriters. So you could see how some of these pieces coming together might actually impact Spotify's bottom line more than seems obvious.
Interesting.
Okay, so stay tuned. Well, so depending on how that plays out, what are the implications for Spotify?
For that specific
complaint,
classification? Yeah, well, so one of the songwriter advocacy groups actually just filed a complaint with the Federal Trade Commission this week, claiming that move was unlawful. They're also being sued separately by a group called the Mechanical Licensing Collective, which is also claiming that this is basically not allowed. So depending on how those two different litigations, I guess the complaint's now full-blown litigation, but the lawsuit at least, play out, it could affect how much Spotify is able to actually integrate audiobooks into its platform.
Ashley, we're jumping around a little bit, which is fine because I brought up the FTC complaint, but I want to go back to this premium plan that you wrote about this week. $5 more a month for Spotify premium, I guess you could call it. What does it actually offer people? And is it enough to get people who already pay 11 or 12 bucks a month for Spotify to shell out $5 more a month?
So I think the headline feature that a lot of folks have been waiting for is this hi-fi, so high fidelity audio. It is already available on some competing streaming services like Apple Music and Tidal and Amazon Music. But Spotify announced it years ago and never launched it. And so it might finally be coming now. And then also some playlisting tools around sort of designing playlists without even your asking.
All right. I don't know a lot of things as most of my team or my family would remind me technically, but I did grow up with a lot of brothers and a lot of music in the house, and there were turntables that were floated up so that, vibrations didn't move them, and they were into speakers in a big way. Like if you don't have a device that is capable of high fidelity, does that matter?
I think, I don't know if it matters. I guess it's just if you are a person who cares about the high fidelity audio and you do have the setup that would actually benefit from that.
Just curious.
Yeah.
Was this the promise of Tidal years ago that they would? Is
Tidal,
this the equivalent?
yeah, Tidal definitely tried to make this kind of their big differentiator.
But so now Spotify caught up with what Tidal offered back then.
Seemingly they will. Yes. Okay. This hasn't launched yet, but they did announce this years ago and never launched it. And I think, again, Amazon Music and Apple Music began launching it as well. So yeah, it's a bit of product parity here.
All I know is music for me, like I listen at home on my way, I'm constantly tapping into this.
The discovery part, though, that Spotify, for me personally, with Discover Weekly, I don't know if even they still call it that, Ashley, or like your daily mix. I don't even know if they still call it that. But the fact that it can surface music to me that I wouldn't normally find is, I think, really valuable. We only have like 10 seconds left, but that's a big part of the equation here, no?
Yeah, and that's why I think this premium plan will include some playlisting features. Like playlists have really become the thing that people know Spotify for, so that's a big part of it.
All right, great stuff. Hey, listen, thank you so much. Really appreciate it. Ashley Carman, music and audio reporter at Bloomberg News, joining us from New York City. You're not going anywhere, right?
I'm not going anywhere. I'm staying on Spotify.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. We've got, just under 18 minutes left in the trading session. I know, time flies.
It's Friday. It's July Friday, Carol. If you're just joining us.
I don't know what's been wrong with me
If you're just
this
joining
week.
us, Carol started the show by saying it was July 14th.
There's many things wrong.
That's okay.
Yeah, I know. Thank you for setting.
The
Tim
time.
always keeps me on the straight and narrow.
I guess that's the expression. We need Doug Krisner.
Where's Doug? Doug, where are you? Dial in.
I'll tell you where Doug is.
We'll take the call.
Doug is relaxing because it's his Saturday.
He's like, I'm not playing with you knuckleheads. I'm
Can you
done.
imagine?
No.
Get a call from Chris.
You can call in, Chris. All right, let's get to it. Because lucky for us, if we don't have Doug Krisner, we do have Aaron Kennon, a favorite of our show, co-founder and CEO of Clear Harbor Asset Management. They've got about $1.5 billion in assets under management. He joins us from Stamford, Connecticut. How are you?
Doing great. Thanks for having me back, Carol.
Hey, nice to have you here. It's been an interesting week. What we had 4 days of back-to-back records on the S&P and the NASDAQ and NASDAQ 100. We've had a really reset when it comes to the U.S. Treasury rate environment. We've had a Fed meeting, lots of things going on. How are you kind of pulling it together and thinking, okay, here's the investment strategy for today and maybe the next, 6 months or so?
Well, we're always thinking about each individual client, what their short-term liquidity needs are, but really also, of course, what their long-term needs are in terms of their entire corpus and which asset classes really should be allocated within that context and which during this component of the market cycle should be overweight and underweight. And I would just argue that, I think we're at an interesting point for the overall bond market, particularly U.S. Treasuries and mortgage-backed securities. At the beginning of the year, the market was saying 6 rate cuts and the Fed was saying maybe 3. And now it seems like there's been some convergence there where the market and the Fed are now at sort of 1 to 2. And I think that bodes reasonably well for the bond market going forward. I think the Fed's clearly more poised to cut than raise. And if you look at inflation break-evens at now below 220 for the 10-year break-even this morning, and 10-year Treasury yields at 420, that 200 basis point spread gives a bit of a margin of safety, if you will, for those who want to allocate and extend duration a bit on the fixed income front. And of course, equities are all over the map in terms of valuation. You have the
Wait, I want to go to equities in a moment, but I want to ask you about our Ira Jersey, who follows the rates market, reminding us that for 2 years we've had an inverted yield curve if you look at the 2s and 10s. So does that mean to you at some point, oh yeah, we're going to see a different cycle, we're going to see some kind of downturn, we're going to see some kind of recession? Or is it fair to say that we're still kind of, maybe it is different because we're still coming out of the pandemic, so much money's still around, and maybe it doesn't necessarily indicate that we have to have a downturn, but we do have to work through some of this excess liquidity that's been out there?
Yeah, it's a great question. I mean, we have recessions on average over the last 100 years, like once every 8 years. And I think the average economists today think that there's a 12.5% odd of a recession within the next 12 months, which suggests that overall 100-year average. I think recessions are historically very challenging to predict. They usually happen when there's an economic crash that comes out of left field. It could be due to something like COVID or the dot-com bubble or something tragic like 9/11. And so I think it's very hard to predict that. I would sort of say, though, that it's been surprising. We've gone more than 400 days with that inverted yield curve, as you mentioned, without having a recession. We've also had the leading economic indicator index way over the average after it peaks, which it did in December of 2022. 14 months after that peak, on average, we're in a recession. We're not in a recession right now, based on most metrics. And we've gone way over, of course, that 14-month period. And I think to your point about COVID, we had a huge gyration where demand for products rose significantly and demands for services collapsed as we went into COVID. As we came through and out of COVID, that all shifted. And I think the economic data was extraordinarily violent and made it very challenging for economists and market strategists to try to sort of read through the tea leaves as to whether or not we're going to recession or something else.
Well, if we were to go into recession, then what would you think would prompt it? There were some folks who were saying, well, the labor market does appear to be weaker than it seems, but what would you say would cause it?
Well, it's interesting, Tim. I don't think it's for example, market multiples or valuations. That is something that we're very mindful of. We want to be very careful to allocate to extraordinarily expensive items within the marketplace, but that has not typically been a great barometer for the likelihood of recession. I mean, certainly a sharp rise in unemployment, weakness overall in the employment picture. If you look at the consumer, it is under some incremental stress right now. When you think about, sort of auto loans, delinquencies, you think about the rate at which credit card lines are charging. It's about 23% on a credit card right now. You look at the savings rate back below historical averages, and you look at the historical sort of mortgage rate today, incrementally weighing on those who do have a high interest-bearing mortgage. But as some data has shown recently, most people are still under that 4.5% mortgage rate. And so this monetary policy is really, working with a significant lag. But we may finally be seeing that lag weigh in on the market. I'm not calling for a recession, but certainly there's indications that the consumer is on its heels, it's not on its toes, and maybe GDP is poised to decelerate on the margin here.
Yeah, and one thing, when we maybe start to figure out a narrative or trend that's going to stick, we are reminded that geopolitically stuff happens, like in elections. And I'm looking at our market right through, and we're still talking about anxiety in global markets about the political crisis in France following those parliamentary elections. So having said that, just got about 30 seconds, geopolitics still something you keep a very close eye on in terms of how it impacts the trade.
We certainly do. And historically, it hasn't had a meaningful impact on the long-term sort of trends in the market. But we are at this point now where public debt levels are extraordinarily high, both here in the United States, in Japan, and now in Europe. And, we have a lot of uncertainty coming together on the political front. You mentioned Macron in France, and we have Schultz in Germany on his heels and with his party. We have Sunak with the Tory, the Conservative Party. calling for a snap election. And of course, we have uncertainty here in the U.S. And we have the rise, I think all those sort of elections speak to the rise of populism. And when you have a resurgence in populism, you tend to have a challenge as it pertains to maintaining solid fiscal sanity within the public sector.
Aaron Kennon, thank you.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.